Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, we are going to talk about the myth of the housing bubble. This is the anti-Crash Bro channel, if you're just watching us. There's the Crash Bros, who believe every year they've called for 12 years in a row of a housing crash. It hasn't happened. This is from an article from Business Insider. We're going to go through, talk about some points in the article, and then a bunch of graphs. We have probably 15 slides. This is all government data. This is not like other channels where they make stuff up and then they show the slide of stuff they made up that bears nothing in reality.
Okay, so this is government info. Take it for what it's worth. Let's go.
Okay, what I really thought was fun about the article was the little subheading down there. It's time to face facts. Sky-high home prices are here to stay. Okay, so let's start with a couple key pieces of data here. First, 2023 U.S. population grew by 3.8 million. It is the largest one-year increase in U.S. history. Juana, how many residential homes did we build last year? Do you remember?
About a million.
No, it was 6 something, remember?
Oh, was it?
Yeah, it was six.
Okay.
No. A million was like the total including apartments.
Okay.
So built about 600 single-family homes. Because that's really what we're talking about. We're not really care about like apartment rental.
600,000.
600,000.
Right.
We don't really care about apartment rentals. We just care about homes. So 660, I think, was the number. I think this year they said they were going to build 740.
Okay.
Problem is we added 3.8 million people. You're probably saying, so do you know where the 3.8 million came from?
Where people come from in general?
Where they come from?
They come from their mommies and their daddies.
Their mommies. So about 3.4, 3.5 million births.
Okay.
We added those people. And then we also, remember that we also had like 3 million people become adults. We had some immigration and we had people die off. Right? Okay, next.
Wait. Okay, so the people that died off, I know you were waiting for the boomers to just go poof and go gently into that good night. They didn't do it. They're still here.
The youngest boomer, guys, is 59. So this idea that, I remember somebody said, but Todd, half the boomers will be dead by 2029. And I'm like, wait, that 5 years? So half the boomers are going to be dead. Half the boomers won't be dead in 20 years. I'm sorry. Okay. Housing inventory is already historic low. We've got a chart that will show this. The available number of homes for purchase, historic low.
Right.
Okay. New home construction is now the lowest in 4 years, 2023. And we've got a chart that shows this too. Okay. Before we go to the next slide, macro stuff. We have a lot of people. We're adding 2 to 3 million household formations a year. We're building 600,000 houses. That's not enough.
Yep.
So what does supply and demand tell us?
People are going to start pitching tents in your yard?
Probably not.
Okay, I'm just checking.
Yeah.
No, so supply and demand tells us that obviously we are facing a lot of increased demand going forward, and the supply just is not keeping up with the demand. And the tents are not out of the question.
The tenants, okay. Here's the next couple bullet points. Could be many years before housing inventory returns to pre-pandemic levels. We've got a chart that shows this really well. It shows the pre-pandemic and then the number of homes developed for purchase since then. This is the number one thing I think that surprised people when interest rates went up, that that was the forecast of, oh my gosh, the number of homes will be more than it was in 2000, or 2008 or whenever that was, right? And we'll talk about those because we have those numbers. Low supply, even with low demand, means home prices aren't coming down in any meaningful way. So there is low demand, but there's low demand because there's not enough homes for sale.
Right.
So if you have one house for sale in the country and somebody buys it, then the negative people say, oh, the housing market's the worst it's ever been, only one home sold in the whole year, right? It was the only one for sale. This is from John Burns. If mortgage rates were 3%, 50 million households could qualify for a $400,000 mortgage today, which is a median in the U.S. There's 4.1 million homes sold last year. If 50 million households could buy a house and you only have 4.1 million houses, that's a super imbalance between demand and qualified people, even though they wouldn't all want to buy a house. Right? At today's 7% rates, it's still 25 million.
A lot of people.
For a $400,000 mortgage. Okay, we're going to jump into the first chart here. Mortgage debt service payment is a percent of disposable income. This is from the Federal Reserve. It's 4%. Now, a lot of people dispute this. What? No, that can't be right, because I looked at buying a house and my payment was going to be 32% of my income. So there's no way it's only 4%. How is it 4%? Explain to them how it's 4%.
Right. So it's 4% because they're looking at all homes in general, even the homes that are paid off.
Oh, so if you make 100 grand a year and then you have zero mortgage debt service, we're talking about mortgage debt, not total payments for housing. If you don't have a mortgage, then you have zero. So the 100,000 goes to the disposable income side and zero goes to the mortgage debt side.
Right. Right. So they're looking at everybody. And of course, incomes vary widely. And we know that about 42% of homes in the U.S. are free and clear. So when you jumble all that together, this is the stew that it makes.
98% of all mortgages are under 7%. About 70% are under 5%.
Right.
So a lot of people are making, incredibly. I met an airline pilot. He's paying he lives in the Bay Area. He's paying $2,500 a month for a place in the Bay Area, which you say, how is that possible? He did put money down, but he makes like $300,000 a year. So his percentage, it makes sense, right? Every single person is not trying to purchase at the peak of their debt to income ratio.
Right. And then the other thing to keep in mind is, some of the mortgages, of course, are, the 1, 2, 3% mortgages. And so you've got that going. You've got people who, have paid off their mortgages, different, to Todd's point, different income brackets. So this is just looking at the country as a whole. So this may not reflect your individual situation, but when we're looking at the big picture of the country as a whole, that's what it looks like. We do understand that, for the average person to buy an average home in the U.S. right now, I think the numbers are somewhere around 34% of their income, which is clearly more than what lenders like to see. Lenders like to see 28% or less. So it is definitely an affordability issue, but we just wanted to kind of show you what the numbers look like nationwide when you're looking at all the mortgages put together.
I think there's a lot of people saying it's not possible, if I can't buy a house, that this thing isn't getting ready to collapse. Well, once we go finish all this data, we will have painted the picture of the whole macro system, what the whole thing out there and why this is happening. Okay, this is another great Fred chart. This is the homeowner vacancy rate. This is the homes that are not rentals, that people live in, that are vacant. Now, it doesn't mean if you have a second home, it doesn't mean it's not included in this. It means it's just sitting there not being used at all. It's 0.9%. You can see historically this is about the lowest it's ever been.
Right. So you're wondering, well, why would somebody have a vacant home? And there are a lot of reasons. Generally, they have to do with things like either a home is being renovated, either because it's before somebody moves in or when somebody moves out and they're getting ready to sell it. Another reason might be that they're getting ready to sell it or it's on the market to be sold, and that's another reason why it's vacant. So there are all kinds of reasons like that, but they usually have to do with very specific situations rather than abandonment. Okay.
The other thing I've heard is they say, Todd, the amount of consumer debt people have, it's the highest it's ever been. When people can't make those payments, they'll all get foreclosed, the housing market will crash. Well, guess what else is the highest it's ever been? Wages. So we found this great chart, consumer debt service payments as a percentage of disposable personal income. Guess what? It's pretty average. It's not the highest it's ever been. It's not even close to the highest it's ever been. As a matter of fact, it's pretty darn average. It's 5.78%. So 5.78% of all consumer debt is covered by income. It's
right. So
literally people could just pay off their debt if they wanted.
So we acknowledge that may not be your situation, and this is looking at the big picture. The thing that you have to remember is that, as Todd said, when you're looking at, well, there are trillions of dollars in debt out there. Well, yes, we agree with that, but there's also, like Todd said, the highest incomes we've ever had. So that income is pretty much commensurate with the debt, particularly when you look at the chart and you see that the debt is about average.
Okay. On here, this is the housing inventory. This goes back to 2016, basically. This is the number of available homes for purchase. If I told you somewhere on this chart, interest rates went from 3 to 7% mortgage rates, you would be like, oh, I can't really find, like, where would that happen? Because it looks like it goes up, it goes down, it goes up. This is seasonality. We have more listings in the fall, we have less in the spring. You have the COVID effect, where it went away because of a lot of factors. People are buying houses. But when you look at the total number of homes, you can see this number is 714,000. This is from December. We know that, well, in Vegas, they're dropping. We've lost 20% of our inventory in the last 6 weeks. We're out trying to buy investment properties personally, and we will find what we think is a deal, and we call the agent like, hey, this just came on the market. They're like, oh, I got a cash offer, full price, we accepted it. Like I said, has it been on the offer market 24 hours? Why'd you accept the offer? Oh, seller just said if he could get this, he would take it. And it's gone, so it's off the market.
Right, and if you look at the Vegas market, I mean, our prices are up basically, depending on where you are. You could buy a home back in 2019. I think the average home was around maybe 250,000.
Yeah.
And now the average home is more like 450,000.
Yeah.
So that kind of lets you know what the market in Vegas has been doing for the last 5 years. We understand that this is not reflective of the whole country, but it is definitely indicative of what's happening with inventory and what's happening with home prices.
Okay, here's the next one. Rental vacancy rate. We have heard this theory that rentals are just sitting there empty with nobody to rent. And, well, here's the Fred chart. And you can see the trend the last decade. The rental rate, vacancy rate has dropped to 6.6%. Want it? Does this mean that of every 100 rentals, 6.6 of them are sitting there with no game? They're not rented. There's nothing going on. Okay,
so not rented, yes, but there are things going on. So remember, when a property comes up vacant, there are lots of things that happen. For example, it needs a deep cleaning. Maybe it needs paint and carpet. There are things going on with that property that need to be done that cannot be done with the property occupied. So that's an opportunity for the property owner to spruce up the property, maybe make significant improvements, and then, of course, find a tenant. Now, finding a tenant is not necessarily the easiest process, not because there aren't available tenants, but people have criteria for what they are looking for in a tenant. They want a tenant that is going to be stable, is going to be there for a long time, maybe a tenant that doesn't have pets, or maybe a tenant that doesn't smoke, or whatever their criteria is. So that takes a little bit to find that Goldilocks tenant. Again, it's not because people aren't interested in renting, it's because the landlord is looking for that Goldilocks tenant.
This next chart is the number of single family homes that were built over the last, basically since the 60s. So let's call this 50 plus years, 55 years. Okay. In the last year, there were 800 this says 857. So it's 857,000, which is the Fred number. Now, what's important about this number is if you look historically, we need to have built between 1 and 1.2 million a year. That's what we were building in the 90s, but the country was much smaller in the 90s, about 20% smaller. It's gotten much bigger. And then you can see what happened last decade, we underbuilt.
Well, and the other thing that's happening is, remember, when you have 250 million people, maybe you grow at, a couple million people a year, but when you have 350 million people, now you're growing at 3.5 million people a year. So the more people we have, the more growth we have in population, and that doesn't necessarily consider immigration. So that's an important thing. People are living longer. So again, that adds to that number of people out there that require housing. So all of that adds up to where we are today, which is in a housing shortage. So not enough homes being built, the population growing and continue to grow at a faster rate, not faster rate, but faster numbers or bigger numbers year over year. So that's where we are. So we're growing with bigger numbers year over year, and we're underbuilding year over year.
This is the delinquency rate on single family mortgages. Yes, it is the lowest since it's been recorded. They didn't start recording this until the early 90s. Okay. This is different than the 90-day lates, which they've been tracking since 99. That's a different, it's called serious delinquents, but it's people 90 lates. Like, this delinquency is any late, 30 days, 60 days, 90 days, whatever. You can see it's super low. It's the lowest it's been in about 2 decades. And the trend is going, it's not going up. So this all these rumors about the foreclosures that are getting ready to hit the market when there's a recession. Well, remember that, look back there, 2001, that thing. Where were all the foreclosures and where were all the missed payments? Because if we have a recession, it's likely we're going to have one of those. So
remember, even if people lose their jobs, the last thing that's going to go is their home, right?
Oh, yeah.
Other things will go way before their home does. And the thing about their home is that they have a lot of equity in their home. So when their home does go, then they're not going to just give it away, because they do have a lot of equity, and it takes about 3 years to put a foreclosure through, so they have ample time to find another job, catch up with payments, and not have to sell their home if that's not what they want to do. So the premise that people have to sell is not a realistic one. Not only that, but remember that their mortgage payment is very likely substantially lower than the rent payment would be on a lesser home. So that doesn't make sense. It doesn't make sense that they would sell their home to then pay more for housing than they're currently paying. Not only that, but last is that if you do not make your payment on a rental, you get evicted within days. If you do not make a payment on your home, like I said, it takes about 3 years. So again, staying in the home makes a lot more sense than anything else.
This is the delinquency rate of all loans. So car loans, student loan payments, mortgages, credit cards, everything. It is 1.32%. You can see from this chart, it's literally the lowest it's ever been. There is nothing macro going on that would show we're at some risk of, having some collapse because people aren't paying their debts. Remember, when you watch the Crash Bros, they make up the charts. They literally make them up, and they make them look worse than they are. We actually took a chart that they made where they showed the 1950s incomes versus a house price, and then they showed it today, and it looks like it's 8 times more expensive relative to wages. But when I put the math of the wages and home prices, it was exactly the same number, the difference. But what they did is they made the lines really thick at the bottom, so it looked really close together because the lines were thick. But you got a period lines were skinny, so it looked further apart. And when I did the math, I was like, hey, this is the exact same number. You just made the chart look bad. Like, they just made the chart and then they made a whole video on it. So there's nothing here showing that. Okay, how about this one? This is the total amount of money people have in money markets. Okay, so this is money that they put away. It's like cash. Okay, it's probably earning 3, 4, 5%, but they want to put it away and get a return on it. That 6 number, this number is in millions of dollars. So it's not 6 billion, it's 6 trillion. There are $6 trillion people have in money markets. If anybody's losing their job, they probably have money in cash or in savings or in money markets that they will use to make their house payment. They're not just going to they're not going to give up their sweet 2.5% loan. They're just not going to give that up. They're taking that to the grave with them. They're not going to say, I'm fine, let me foreclose and take that 2.5% loan. I'll just go rent for the rest of my life. Nobody would do that, like what you said.
Right. So, look, everybody's circumstance is different, but by and large, people have, particularly homeowners, because remember, homeowners are kind of different than renters, because homeowners have a long-term outlook, because they've had to save money in order to save for a down payment and that sort of thing. So they do have a different financial outlook. homeowners tend to be a little more financially literate. So that kind of goes to that point that they are more likely to have savings. They're more likely to have sufficient financial sophistication to weather an economic downturn or a job loss or something like that. That's not disparaging toward renters. It's just that these people have historically had a little more financial literacy than renters.
Okay, remember this number, $6 trillion, okay?
Mm-hmm.
Right, here's the next slide. This is checkable deposits in cash. So what this means, and in currency, which means cash, this is cash and money in a checking account. It's immediately spendable. They don't have to go to Schwab or E-Trade or one of these, or Wells Fargo or whoever's holding their money market and say, hey, I need to liquidate this and get my money. And usually it takes like 3 days to get your money. This is immediate spendable money, okay? It's 3.9 trillion.
Mm-hmm.
Now you're probably saying, well, why is there less? Why is there more in money markets? Well, Juana, what does your checking account pay in interest?
Nothing.
What does your cash pay in interest?
Nothing.
What can you get in a money market right now?
4 or 5%.
4 or 5%. Okay. So we had 6 plus, and now we have about 4. We have $10 trillion. Half of that's ours. Okay. $10 trillion. And remember those really nasty charts the Crash Bro showed you with the credit card debt? It's $1 trillion. So literally, people have 10 times as much money as they have this on this puny credit. But they make it look, and they use the word trillion to make it look like there's some crisis going on. So when you look at all these numbers and you look at the whole totality, where's the bubble? Like, how could there be a bubble if everything's up? People have money. Nobody is getting literally, you could not paint a better picture for the economy or for housing. Yet you have the most dire, and this is probably the 11th year straight. It started in 2013. 2013 was the shadow inventory. It was the second wave of foreclosures. There were 500,000 to 1 million in the U.S., and they were all getting ready to flood. They were like, banks were getting ready. Like they were all calling each other going, what day should we flood the market and crash it again and wreck the rest of our portfolio? Like the banks would intentionally do that, right?
Right. So, we do acknowledge that the credit card debt is out there. There are also credit cards that are really expensive to have because their interest rates are, horrible. They're 25, 30%, whatever they are. There are still introductory rates out there that are 0% or a couple percent. I saw one a couple days ago that was 0% for 18 months. And so, if you've got credit card debt out there, you could take advantage of some of the specials that they have going on and maybe move your debt from your 25, 30% credit card to one of these 0% cards. And
it's not for new spending. It's only to transfer.
Right. Yeah. It's for new borrowers and those sorts of things, So even day,
bunch of rules.
Even day, odd Tuesday, full moon, that sort of thing. But they are out there. So again, homeowners tend to be a little more financially literate. They tend to be a little more savvy, and they tend to shop around maybe and figure out who's got the deal going on, and maybe get their debt under control a little bit better than people who have not done some homework. It does take effort. They are out there. No, please don't leave me comments tell you which credit cards it is, because obviously it's based on your individual situation with your credit score and your debt to income ratio and your all that good stuff. So it doesn't, whatever I get, he's not going to get. Whatever he's not going to get, somebody else is going to get, and that sort of thing. So it doesn't work like that. So you do have to shop around because it is absolutely dependent on your particular situation. But they are out there. So if that's something that you need, take a look around, see how you can get some help. But like I said before, financial literacy is super important.
Yep.
So educate yourself so you can be a good steward of your hard-earned money.
Okay, so after looking at all this data and then watching a bunch of our videos, Goldman Sachs came up with their model for home prices out till beyond 2027. Looks like it goes out to maybe 2028 on this chart. And they're expecting home prices to improve. Now you can see that the little wavy up and downs, those were not little housing crashes. That is, homes tend to sell for more in the spring and less in the fall. every single year, you can see this trend happens. It's been more exaggerated the last 3 years because of the lower number of homes. So the median amount changes more. Those are not little housing crashes or fake housing crashes. Those are just the cyclical nature of housing. And then they're predicting it to go up. And if you look at that trend line, it basically exactly mirrors pre-pandemic, 2013 to 2020, where home prices just kind of went up that normal 5% a year. Nothing fantastic. They're not predicting a crash. Remember, they give this information out to their investors so their investors can make decisions on all their assets they're holding, portfolio, whether it's in real estate that they own individually or in a REIT, real estate investment trust. Now, this is only for home prices. This is not for office, industrial. Office is kind of, depending on the city, it's kind of getting beat up right now. That's a whole other video. So I apologize if you came to the channel expecting, the more Crash Bro stuff, but we basically we didn't make any of these charts. We don't make the charts up. There's zero data macroeconomically that housing is getting ready to crash. Despite all that anecdotal stuff you've heard, none of it's true. There are not millions of new homes that haven't been sold that are just sitting there and the builders are waiting to dump them all on the market. We've been hearing that one now for, I think, 3 years.
Right.
Yeah.
So the bottom line is still the same that it's been. There is insufficient supply. There is ample demand. As far as people's ability to meet their financial obligations, they appear to be pretty reasonable. Educate yourself financially. It will serve you well. Please leave us your real estate related comments. We appreciate you watching the video. Please remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.